And in our research, we found a strong appetite within local authorities for things like accelerated development zones or local asset-backed vehicles, but also a feeling that these perhaps haven't been able to be used to their full potential. And so we've outlined 3 ways in which we think these could have a better use made of them. Firstly, the centre must be willing to play a more enabling role, and also be willing to relinquish some degree of control, for instance, over future taxation revenues, if we're going to use this innovation better. Secondly, risk aversion at the moment is currently in favour of not using any innovation, and I think we need to address this, and we need to create an environment which incentivises appropriate risk-taking. And I think that's the job of local authorities, central government and auditing bodies, to try and create an environment which is more accepting of innovation and encourages the reasonable use and reasonable risk-taking. Thirdly, there was a sense that perhaps we need to demystify some of this innovation. We've got a lot of models, some of them are quite complicated, and perhaps the capacity doesn't exist throughout all of the local government sector. So I think we need to start addressing that demystification, that complexity. Perhaps that's something that at a regional level, in terms of task forces, regional improvement and efficiency partnerships can help with. If we move now to the private sector, I think it's clear that the level of public funding is probably not going to be enough to meet the capital investment challenges. So the public sector needs to think about how it can incentivise the private sector and how they can engage better. I think there was a sense in our research that in the good times not enough attention was paid to that. But I think now we do need to look at how the private sector can be incentivised and how better, stronger partnerships can be formed. So firstly, in terms of regeneration, we thought that packaging schemes together, not necessarily in the sense of a local asset-backed vehicle, but in terms of mixing together different capital investment strategies, schemes that might be low risk from building schools from the future, or healthcare investment, or things that are very commercially viable, with the much higher risk schemes from the private sector's perspective, but which have obvious social advantages and benefits that local authorities would like to see happen. So I think local authorities should start looking at being more strategic about the way they package together their capital investment plans. Secondly, we heard from Hugh that the private sector likes upfront commitment because it reduces the level of risk they're presented with when they embark on development. But to do this, the public sector needs greater flexibility of funding. So in our report, we made 2 recommendations that could help increase the level of flexibility, one of which is the allocation of 5-year capital grants and comprehensive spending reviews, and secondly, in the form of a wider single capital pot. And thirdly, another thing that might help the private sector is if there's greater synchronicity in terms of local authorities in the same economic area and their capital investment programs. It presents the private sector with an altogether more manageable terrain. This leads on to another section we thought was important, which is the public sector working better together with other public sector agencies, both at a local level, sub-regional level, and a regional level. So at a local level and even sub-regional level, asset management can be a key driver of capital investment. Things like joint estate strategies can help local authorities to isolate the assets they don't necessarily need anymore, and then these can be used, recycled, and contributed towards further capital investment. We also saw that pooling resources across local authorities, across sub-regions, and even regionally could be a massive benefit. It could help provide that upfront funding commitment that the private sector needs, and also could help provide the right impetus, the right level of momentum for the larger scale schemes that might otherwise not happen. I think the regional development agencies have already been mentioned. It might be hard to reverse the planned spending reductions, but I think there is a need to rethink the regional tier and the role of regional development agencies. Perhaps if they're not to be given such high levels of funding anymore, there could be a role for them as a coordinating force at a regional level that can be there to generate critical mass and to provide impetus and generate momentum for capital investment. And finally, it wouldn't be a capital finance report unless you mentioned the private finance initiative. I think we're all aware of some of the problems that this model has encountered over recent years, which is why we believe now it's more important than ever that a level playing field approach is taken to private finance, and that central government must continue to commit to support capital investment through whichever means the local authority chooses, of course providing that value for money is achieved. Now these improvements can get us some considerable distance, but I think to fulfil the needs of capital investment we must look also at generating a new suite of capital financing options. So at the moment local authorities do have the power to issue bonds, but it's currently dormant and it's not really utilised. That's because at the moment Public Works Loan Board provides a much cheaper and plentiful source of capital. But I think through exploring bond finance, through going directly to capital markets, and not necessarily through the centre, local authorities could release a range of benefits and compensate for this increased cost of debt. And this is something that obviously may not be applicable now, but as we go forward into the medium term, might become more and more viable as an option. So by issuing bonds, you may maintain a credit rating, which increases the level of financial oversight of your operation. This can lead to greater project management and financial disciplines, and it also demonstrates a level of independence and maturity and helps perhaps counteract some of the dependence on the centre that we've started to see recently. Obviously there would be hurdles to overcome. For instance, smaller authorities may find it unviable, the cost of maintaining a credit rating, the fees, etc., which is why there might need to be some sort of equalisation across the sector and aggregated vehicles that could help issue bonds on their behalf. But obviously in an era of public sector debt reduction, a bond that is financed through general revenue, through taxation, might not be particularly favourable, particularly if it counts towards public sector net debt. So we moved on to the concept of a revenue bond and looked at whether or not these might be an appropriate form of finance in this era of constrained borrowing, particularly if it's prudential borrowing. If the project could, in a sense, be self-financing, could these bonds be issued by a joint venture? Would that make them off balance sheet? It's something that we think local authorities would be prudent to explore, and it may be a solution for an era of high public debt and constrained prudential borrowing. There are also a number of funds of non-borrowed finance for local authorities. I think a lot of work the NLGN has been doing in the last year has been on the concept of a mutual fund, mutual reserves fund, putting the £30 billion worth of liquid reserves that councils have built up over the years. Perhaps that could be used to help finance infrastructure. Similarly, pension funds, there's about £120 billion worth of funds in the local government pension fund. Perhaps this could be put to the dual purpose of generating a good return from the pension fund members, whilst also fulfilling some social benefits through investing in local investment schemes. And obviously, there's a huge potential here for domestic reinvestment, but a lot more work needs to be done to make this reality. Now, Hugh mentioned earlier revenue streams. I think to embark on borrowing, it is important to also have a revenue stream to pay for it. So I think that local authorities should be bold in finding areas in which these revenue streams might be able to spring up. So of course ADZs are one of these options, but we also think that user charging could be explored and should be employed. And if used cleverly and strategically, it could be used to meet several strategic objectives at once. So not just providing a revenue stream, but also to fulfill perhaps carbon reduction measures at the same time. So, and finally, I think to sum up the report, there's potential for central cuts to dictate a generation of underinvestments, but we should question whether it's right or indeed necessary for problems at a central level to percolate through to local authorities. I think the key message that we wanted to make with this report is that local authorities must rediscover the skills and techniques that can help enable self-determined capital investment. We see it as vital that this forms the vanguard of future locally driven investment.